We've got some breaking news out of China this morning on its latest GDP figures. First of all, you're looking at live pictures of a press conference on the country's economic performance for the first half of the year. Right now, Q2 GDP grew 4.3%. That is lower than Bloomberg estimates of a 4.5% growth and slows from 5% growth in the first quarter of the year. Other indicators we're looking at this hour: retail sales that surprised to the upside 1% versus estimates from Bloomberg that indicates a contraction of 0.1%. In the previous month, retail sales declined 0.6%. Industrial production rose 5.3% versus estimates of 4.6% growth. In May, it rose 4.5%. Also got fixed asset investment figures. That one fell 5.7%. That is more than the estimates of a 5% decline, and also more than what it fell in May, which was 4.1%. And for more, we are joined by CNA's Deborah Wong. She joins us from Shenzhen. Debs, just taking a look at the figures, China's Q2 figures coming in the back of a protracted energy crisis. So did the headline growth meet expectations? What did the numbers tell us about the health of China's economy?
So we're seeing figures for Q2 coming in at about 4.3%, and that's a tail end of China's 2026 growth range of 4.5 to 5%. And this is very close to predictions that analysts have given ahead of the figures, because China is weathering a global economic slowdown at the moment. And it's not surprising, because analysts had also warned ahead of the figures that China is going to be facing the impact of a confluence of factors. We're talking about the prolonged closure of the Strait of Hormuz leading to an energy crisis. We're also talking about domestically the impact of the real estate slump, and that's all affecting investor and consumer sentiment across the board. So we're taking a closer look at the figures right now. Retail sales in Q2 coming in at 1%. Now that's a drop from 2.4% in the first quarter, and we've already seen clues, so it's not very surprising. In May, in fact, the figures tracked a decline, the first decline since the lockdown measures were lifted in 2022. And, analysts are saying that's attributed to also stronger demand in Q1 and also the last quarter in 2025, because the trading schemes for electronics and EVs probably had a front-loading effect. And that's also likely going to be concerning for policymakers, because domestic demand is something that they've been trying to amp up and position as a growth driver for China's economy. Now, fixed asset investment in Q2 falling 5.7% here. Q1 was up 1.7%. Now, we take a look at this. The drop is likely also due to local governments managing debt, manufacturing investment also going down because it's also due to anti-involution policies playing out as companies try to reduce overcapacity and cut the price war. So this overall points at structural adjustments, and we shouldn't be looking at it too negatively, because right now spending is shifting more towards higher valued sectors like tech, which is that sector that's driving robust exports. We're seeing that figure go up as well. And also because the global AI boom is pushing China chip exports, and the energy crisis is also fueling demand for clean tech and for energy. And we did see firsthand at the Canton Fair in April how sales for energy, for wind and solar energy tech has gone up. But we're still keeping an eye out on how China is balancing both growth drivers, consumption and exports and tech-driven growth, because rising raw material costs are squeezing manufacturers' profits, and that could impact the broader economic growth.
And Deb, so what does this mean for the rest of the year then? Are policymakers likely to roll out more stimulus to support growth?
I think stimulus is definitely on the wish list for many industry leaders and Chinese residents, but we are unlikely to see a very aggressive stimulus, given the lower GDP range for 2026 already signals that China has a higher tolerance for weaker growth. Policymakers at that point also emphasized letting existing policies such as the AI Plus initiative play out first. And we're seeing that bright spots, coming out of those kind of initiatives. and that could, actually bolster the growth without leaning too heavily on fiscal stimulus. For instance, I mentioned earlier China's chip exports, in fact, nearly doubling in the first half of this year as global AI spending goes up. So with China sustaining its push for resilience in science and tech, we could potentially see that momentum continue. But that said, it doesn't mean that the government is not concerned. In fact, earlier this week on Monday, Premier Li Qiang met with industry experts, economists, to get some suggestions on how to improve the economy. He said that doing a good job in the second half is crucial to meeting this year's targets. So we will be watching out for more possibilities of expansionary policies, given that he called on China to step up a counter-cyclical adjustment. And he also stressed on stabilizing employment to boost domestic demand. We will be looking out for the Politburo meeting that's scheduled to happen at the end of this month to see whether any adjustments will be made. It's a session where policymakers typically review the performance of the first half of the year and make any changes accordingly. Liz.
All right. Many thanks for that. Deborah Wong there reporting for CNA from Shenzhen. And we get you now market updates with stocks in Greater China notching gains there. Shanghai Composite near the flat line, but just a touch higher. Shenzhen Component about 0.5% in the green. Hang Seng about 0.8% higher this hour. And right now, we want to get more reactions from Tommy Xie. He is head of macro research at OCBC Bank. Tommy, thanks for joining us this hour. Just want to get your initial reaction, of course, to that GDP figure, 4.3%. So that misses expectations. Also slowed down there from the 5% we saw in the first quarter. Of course, your reaction is also how much of this is also due to the global oil shock?
Hi, good morning. So I think certainly this is a slightly disappointed number. So it's a very typical K-shaped kind of the recovery story we are seeing in China. So, but of course, I'm still waiting for the detailed breakdown of the GDP. But my guess is the capital formation is quite weak. If you can look at the fixed asset investment, in particular, the real estate investment has been particularly weak. So we are seeing some kind of a spillover from the weaker real estate investment as well. But how much is from the oil spillover? I think right now we still too early to tell. I guess that the impact will be still quite limited at the moment. In fact, I think we are still going back to this K-shaped story. So the old part of the economy is not doing very well, but the new part of the economy will continue to outperform. So the AI-related stocks, the topics has been doing well. In particular, if you look at the trade data, which is published yesterday, so we are seeing very strong exports of the AI-related stocks and the parts, right? So in particular, you look at the chips, your automatic data processing machines, etc. So, for example, in the first half of this year, in terms of China's total exports, about 15% came from the AI intermediate goods. So that's really up from only 10.7% we saw in 2025. So that will continue to be the very supporting factor to China. But the downside, of course, is the capital formation is very weak. Consumption is still quite sluggish, I guess. So that will continue to become one of the challenge for the second half of the year. So my guess for the second half, we are thinking maybe the GDP will be still hovering around 4.5, 4.6% kind of the range.
Yeah, the question is whether more stimulus measures will be introduced. Your thoughts on that based on what we're seeing from today's figures?
Yeah, I think the focus will probably go back to the consumption, right? Because to be honest, I think China has very clearly benefits from the AI story, from the new technology, etc. So, but the question, how can we boost the consumption, right? So just now, Deborah mentioned towards the end of this month, we have the Politburo meeting. I think that will be particularly important. So I think I'm actually watching for any clues, whether China is going to announce any measures regarding the consumption measures. So what's interesting, I think this week, China also unveiled the 5-year targets for the retail sales of the consumer goods. So by end of 2030, right? So China want to boost the retail sales of the consumer goods by about 60 trillion. So that's implied about every year 3.7% growth for the next 5 years. But you look at this year, in the first half of this year, I guess the retail sales of the consumer goods is only grow about slightly above 1%. So we are still very far from this 3.7% target. So from that angle, I guess something China needs to do is really to boost the consumer goods consumption. So one of the low-hanging fruits, of course, maybe China can further increase the consumer subsidies, but the structural problem is how can China increase the income growth? I think that's something we need to monitor in the near term. But on the other hand, I think the service consumption will be something China will also focus on, because that could be easier for China to roll out some of the scenario, for example, the silver consumption or tourism consumption, etc. I think overall, I think two parts, consumer goods and the service. So those are the two areas I think we are going to looking for towards any announcement towards the end of this month.
Right. I just want to stick on the retail sales figures for a bit, because actually that was not too bad. 1%, I was up 1%. The estimate was that it would come in at minus 0.1%. And the previous month it fell 0.6%. Is this a surprise? And if this, do you think this sort of figure is sustainable? Is this does this look like a one-off to you?
I mean, to me, whether it's 1% or 0.1% doesn't really matter a lot, because anyway, it's a very small swing at the current stage. I think there may be some impact from the swing in the gold prices as well, because as you know, jewelry for the past half year are a very important driver behind the retail sales as well. So I think that may contribute a little bit to that. But again, my key focus is really what's the underlying strengths behind the consumption, right? Because the underlying strengths behind the consumption is your income growth, is your income expectation, and your wealth effect. So those three things are the most important things I would personally paying more attention to. So to answer your question, whether this is one-off or whether this is more sustainable, I think it's really going down to these three parts, right? So unfortunately, right now, I think we haven't seen the strong evidence regarding income growth and the income expectation. So in terms of the wealth effect, yes, we are seeing some kind of the wealth effect from the AI stocks and the semiconductor stocks, but this is not broad-based, right? So I think hopefully, we are going to see a more sustainable rally of the China's equity, not only in the AI stocks, but also in the broad-based stocks. I think that may potentially also be the long-term supporting factor to the overall consumption stories in China.
All right, Tommy, appreciate you breaking this down for us. Tommy Xie, the head of macro research at OCBC Bank. And just to recap, the headline number for you from China's GDP print, its economy grew 4.3% in the second quarter for its weakest pace since 2022. And that is also below the consensus estimates of a 4.5% growth.